Good afternoon, everybody. It's 1:30 on this busy Tuesday, and we're joined by Adam Collins of Movement Capital. Adam has been joining us regularly every week to talk about the latest CoT reports and the market seasonality. Adam runs three websites, which I don't have in front of me. One is Free CoT Report. Another one, Adam, if you can help me out, Seasonality.
Yeah. So the three we got, in fact, they're right here. We got freecotdata.com, which is sort of like market positioning. Then we got commodityseasonality.com. And then the third one is Simple Stock Model, which is sort of a bunch of different indicators for the S&P.
Gotcha. So before we even get going, how do you find the time to update all these?
That's a great question, Mike. No, so I've automated a majority of the data retrieval. But when it comes to syncing it up with a website, it typically takes like an hour each week. So it's not a huge thing. It's not something that looks like there's still something to it.
Yeah, that's not too bad because it's a ton of data. So it seems like a lot of automation then, which is great.
Yeah.
And then if you could just speak a little closer to the mic, you faded out a little bit.
What about right now?
Yeah, that's great. And so every week for the past few weeks, Adam's been providing tons of great information, seasonality, and the latest CoT. And I'm sure Adam's got some interesting tidbits for us this week.
Yeah. So let's run through it. First things first, none of this is investment advice. And for new listeners, when it comes to positioning information, I'm talking about the CoT report, and it's a weekly report put out by the CFTC, and it basically outlines how different types of traders are positioned in the futures markets. And this is an example of what a CoT report looks like. So in this one, this was for corn this is just an example image, as of March 7th, 2017. It's got these different categories up here. It's got, producers, users, swap dealers, managed money, all those categories. They've got long, shorts, and then contracts that are spread. And so it's one thing to know, net positioning. So in this example image, money managers were net long something like 75,000 contracts of corn. But you need to know if that number is extreme or not relative to the past. And so all I do to give that positioning number context is make a 5-year percentile. And so these lines at the bottom right here, that's the 5-year percentile number, and it's a scale from 0% to 100%. So if it's 100%, it means that category, like producers and users or speculators, it means if it's 100%, it means they're more net long than they've ever been over 5 years. And if it's 0%, it means they're either more net short, or let's say they're running super low, long exposure relative to the past 5 years. So it's just a percentile is an easy way to sort of normalize the positioning to cross compare between all these different contracts. And so the way this site is organized is I've got individual graphs for each contract. And then, honestly, the main thing I look at is the dashboard page. So this is sort of aggregating together current positioning by trader category for all these different contracts. So right here, the top graph, this is spec positioning in commodity futures. Stuff on the left where the 5-year percentile is, high. That's where those are contracts where speculators are quite net long. And then on the right, we've got the opposite case, crowded shorts. So I guess, right off the bat, and I talked about it last week, but it still bears repeating.
So wheat's still up there, right?
Correct. Yeah, no. So wheat is still up there, but I think that definitely is interesting. But I think the more interesting development is there's just a lot of commodity contracts that speculators are either very net short or they haven't run this little net long exposure in a while. And I think I talked about it last week about how, no, this is actually in an email, but so the current narrative right now is that gold is a very crowded short trade, and it's not really true. Gold is 100%, it's not a consensus long position, that's a for sure. But there's a difference between a crowded short trade where there's a lot of money leaning on the short side, and then just a trade where, basically in the gold market, speculators ran a net long from 2006 up until a couple weeks ago. And they went net short for the first time in like a decade, a couple weeks ago. But there's a difference between being crowded net short, which is honestly the case in something like platinum, and then, a slight net short position can still be extreme relative to the past 5 years if traders have been, leaning very bullish, the past 5 years. And so gold positioning is extreme, but that doesn't 100% translate to it being a very crowded short trade. But on the right hand of that chart, you see other contracts where, basically being long is anti-consensus, and it's a bunch of stuff. It's sugar, gold, coffee, platinum. And in fact, the biggest one right now is silver. So we can dive into that, see what it looks like. So this is a commodities page, scrolling down to the silver chart right here. All right. So in fact, it's doubly extreme. We've got, speculators that have a 5-year percentile of 0%. On the flip side, we've got producers and users that have a 5-year percentile of, it's not quite 100%, but it looks like it's north of 90. What that means in that category is typically called commercials. So when commercials hedge, there's two types of commercial traders. There are commodity producers, the entities that make the commodity, and commodity users, the entities that use the commodity. So when you hear about producer hedging, they're always selling futures because they're making something, and they sell futures to lock in future prices for their future inventory. When users hedge, they always buy because basically they're fixing the cost of their future inventory in the future. And so when you see like a 5-year commercial percentile, get really high, like north of 90%, what that says to me is you don't have a lot of producers selling and you have more user buying. And so silver miners, on average, they don't really hedge that frequently. They're sort of discouraged too from the market, but even accounting for that, silver producers aren't shorting a lot of silver, which infers that they think, okay, price of silver is very low, probably don't want to lock in, current cost for, 6 to 12 months down the line. And so positioning is definitely really extreme in silver, but it's not unique to silver. It's most of the precious metals. On the other flip side of it, like Mike mentioned, we've got wheat, which is a crowded long. And so it's not, a true, 5-year extreme in positioning at 100%, but we're close to it. And what's interesting with wheat is that more often than not, like the spec positioning, it's synonymous with price action. So big uptrends typically lead to crowded spec, long positioning, vice versa on the downside. But with wheat, we're definitely off the highs by around, I haven't checked today, but probably 10, 15%. And so what that says to me is, in a nutshell, this is sort of a tangent, but people's number one mistake with CoT data is they look at a chart like this, and they see, okay, traders haven't, sort of been this bearish on silver in 5 years. It's a lot of people sort of immediately jump to, I'm going to go long silver. I'm going to fade that, right? Mm-hmm. If you think about it, so like put yourself in the mind of somebody that's short silver right now. Are they underpaying? No. It's been a relatively, smooth downtrend over the past little bit. And so there's little reason for them to liquidate their shorts and to pull exposure. But if you got a situation where, let's say, silver rips 7% tomorrow, okay, then it's sort of a fire in the theater thing of you've got everybody on one side of the boat, and most importantly, there's a catalyst for their action. And so just as that really hasn't been the case in some precious metals, although palladium's been sort of strangely strong lately. But what I'm getting at is in wheat, that is an example of you got crowded long positioning plus price action that puts those people under pressure. And that translates to a more actionable setup in my mind than something that's just, extreme positioning alone. But, we've only talked about commodities. We can look at financial futures. So there's no real crowded longs in financial futures. I mean, so NIY on the far left, that's the Nikkei. So Japanese stocks are, speculators definitely long them. And then the US dollar index DX right to the right of that. That's definitely sort of a not fully crowded long trade, but people are definitely leaning long in it. From the right-hand side, you can see two contracts where positioning truly is extreme. And I define extreme positioning as a 5-year percentile, either greater than 100 or greater than 90% or less than 10%. And so traders are definitely betting on both a weaker Swiss franc, and a weaker New Zealand dollar against the USD. And it was interesting to me because the franc, obviously it's synonymous with the dollar was sort of under pressure last week before. And so franc sort of caught a bid. I think it was up around 2.5%, 3% before today, which to me, it's not sort of enough to sort of, trigger a big spec unwind, but it definitely, I don't know, hit my radar. And so that's something worth watching, is knowing that positioning is very extreme in those two currencies. If the dollar continued to fall back and you saw the franc and the Kiwi dollar catch a bid, that's where you could potentially get the most juice, simply because position is so sort of lopsided. And so that is financial futures. And then this graph right here in the middle, commodity hedgers, this is sort of the inverse of this graph, because this is looking at not speculators, but the commercial producers and users. And just as I say something of how, it's rare to see so many commodities that have sort of bearish spec positioning, the mirror of that comment is, it's strange to me to see so many commodities where commercials are this bullish, and bullish being defined as, a lack of producer selling and more user buying. And so we see that in a bunch of contracts: coffee, sugar, platinum, silver, soybean oil, natural gas, WTI a little bit. And so that this graph hasn't looked so, left-hand heavy in a long time. And it's all sort of the same trade. Like, dollars called a bid, commodities have gotten killed, traders are really short commodities. It's all sort of the same thing. And that's positioning. We can dive into any sort of individual charts if you want. But to give a brief overview of seasonality, just as I've got, like all these individual graphs for each contract, main thing to look at is the dashboard page. And so this is sort of average monthly seasonality by contract, by month. So like the default view is January, but let's look at September. So for the month of September, what historically has done well has been sort of a motley crew. We've got, let's see, ZO, that's oats. Then we've got gold, the 30-year bond, euro, sugar. And then on the right-hand side, historically, the weaker performing contracts in the month of September have been, it's honestly a lot of agricultural: soybean meal, soybean oil, corn, platinum, and then soybeans. And for full disclosure, this is for front month positions that are roll adjusted. And so this is looking at, the most liquid contract.
And we also have S&P down about 1% on that as well.
Let me see, where on the seasonality?
Yeah.
Yeah. I mean, it's typical, late summer is sort of the most dominant trend of seasonality this time of year is, and it's not a new concept, but it's that risky assets tend to, be more risky, and that sort of risk off assets like the 30-year bond, gold, and yen typically catch a bid. And then turning to sort of the term structure of commodities, which honestly, term structure is really important. And I don't think it gets enough playtime because, to be honest, if you're purely an intraday trader, it doesn't matter that much. But if you're holding positions in, I'm going to measure in weeks or so, term structure really matters because that's sort of your cost to hold the position. And so if it's in contango and you're long, you're going to incur that if you have to roll the position forward. But vice versa, if you're long something that's in backwardation, that's sort of a positive roll yield you can expect. And what's interesting about this chart, I know it looks quite boring because everything's around zero, but what's interesting about it is that when we started the year, a number of commodity contracts were in backwardation, specifically, WTI. And that was interesting because that was for the first time in a long time that a lot of contracts were in backwardation, and that sort of lent itself to the long commodity thesis, because when a bunch of commodity contracts are in backwardation, that sort of reduces your bleed of being long commodities, which makes them, to some people, more attractive. But that's changed since then. And a lot of these contracts in backwardation, these curves have flattened out, and there's no real contracts in substantial, so this backwardation in like lumber and WTI, like 1%, doesn't really matter. But on the right-hand side, there are definitely a number of contracts in steep contango. Nat gas, which is the natural gas curve, is typically in contango. We've got coffee, corn, and wheat. And so what that means is, and by the way, this is the degree of contango or backwardation between the front month and the second month. And so to annualize it sort of depends on what those 2 months are. But anyways, so with those contracts on the right, so if somebody came to me and said, okay, I'm bullish coffee because of XYZ, right? And basically I would look at them and say, okay, so front month, second month, contango is around 3%. If you annualize it, I think it's around 12, 15%. That's a huge, thing to bleed just to maintain the position. And so, I don't know. I think term structure, especially if you're a longer term trader, it's very much worth knowing. And then the final chart on this commodity seasonality dashboard page is momentum. So this is looking over the past 12 months, roll adjusting these. So it's sort of replicating if you're a front month trader and you're rolling, what's sort of the adjusted momentum for all these commodities. So you just think of it as like, the top performing contracts. And so we've got, no surprise, we got WTI on the far left, and then heating oil right behind it. On the right-hand side, we've got platinum, coffee, sugar, soybean oil. And so this is sort of actually an even split. We've got some commodities that have ripped, some that haven't. And the reason why this matters, it's not purely an observational thing. Momentum as a metric matters quite a lot to me, because momentum, especially for CTAs, I mean, they're trend followers. And so this is a long-term momentum metric, 12 months. So what you can take away from this is, if you're a longer-term CTA, you're probably, not short WTI or wheat or coffee or the ES or anything like that right now, just because the trends are so positive on a longer time scale. Vice versa, if you're a longer term CTA, you're probably leaning to the short side in a lot of stuff to the right, like, some of the soft commodities. And we can also dive into any of the individual graphs if you want. But that is a sort of an overview of positioning and seasonality right now.
So I guess going back, can you explain more about wheat, not necessarily from a trading perspective of, looking to fade the move, this or that, but actually how it can stay on the spec side as 97% long, or 5-year percentile, like 97% on the overbought side, when we've had roughly a 20% decline, and we've been down here now for a good 10, 14 days.
Yeah, I mean, it's rare, but it's not unprecedented, because price or positioning, it's correlated to price action, but it's not 100% synonymous. And so you can totally have a situation like now of where people put on their trade, they get on one side of the boat, it goes against them more often than not, they puke out, sometimes they hold. And to me, it just creates a setup for not necessarily an explosive move, but like, if you stick in something, it keeps them going against you. And it just doesn't end well if, wheat were to continue correcting lower. And so to me, I would sort of classify the crowded spec long in wheat as more vulnerable, simply because price hasn't agreed with them and they're under more pressure for it to, go their way soon.
Right. So I guess looking at things, what sticks out at you here as something that kind of scratching your head that might create an opportunity out of all, everything that you kind of look at here?
So probably the main thing is long USD is crowded, and people might want to trade that, or people might want to fade that typical way by like going along the euro, the pound, or yen against it. But if you've got a thesis and a big component of it is the fact that US dollars are crowded long and maybe they expect that trade to reverse, then positioning could likely be an accelerant in some of the more crowded shorts, like the Swiss franc and the New Zealand dollar. So that definitely sticks out. And then let me think what else. With positioning, it's easy to like look at this graph and get paralyzed, because it's like, oh, look at all these numbers. I only care about the two extremes. I only care about crowded longs, crowded shorts, and then most importantly, if price action is agreeing with them or not. And so like right now, there actually aren't that many like purely crowded trades, but that's why I did mention those two currency pairs, because that's a setup of where I don't know, positioning really is extreme, and so much comes down to the dollar. So it affects everything I just talked about. Then it also affects all this commodity stuff where you've got, you hear about, people shorting gold, and, we talked about the credit position in silver. It's all dollar. It's all dollar related. And so to me, it zooms out to what is the dollar going to do? And then you ask yourself, okay, so what's really impacts the direction of the dollar? And in the short term, that's more of like, an economic data related thing, but in the long term, it's sort of like the relative growth differential between, US and in international economies. And so if we continue, I saw that there was that, GDP now revised up today. If this environment continues of, U.S. economy just standing out as the sole performer and all these other international economies not, then it's just a perpetual tailwind for USD appreciation and then in hand commodity pain. And so, yeah, that's a big focus point, at least for me right now, is USD.
Yeah, I agree with you. The story definitely has been a lot of dollar strength affecting the commodity markets. You look at silver today, actually taking another leg lower and clearly breaking down. But the dollar is only a part of it, because if you take a look, over the past month, for instance, the dollar hasn't strengthened a whole lot against the G10, against emerging markets, absolutely.
Yeah.
And so
I tell you what, speaking of dollar, I read something interesting, I think a week or two ago. It's a blog called, anybody can Google it. It's called Macronomics, and it was an interesting post. He was talking about how, over the past decade, if anybody who runs like a currency carry strategy, the high carry stuff has been, Aussie dollar, Kiwi dollar, emerging market currencies, and then that was always funded with low rate currencies like USD, yen,
right,
et cetera. And so what's interesting now is this is the first time in a decade where the USD is the highest yielding G10 currency. And so it's another, not only is sort of the growth differential sort of, I guess, lends itself to the bullish case for higher USD, but from a yield differential perspective, people aren't funding carry trades in the USD anymore. In fact, they're funding carry trades to invest in the USD.
Absolutely.
Much higher. And so, it's just sort of an interesting
Well, I think
note.
that's part of why we've seen such a move to the dollar recently, is because it's, regardless of the data, it's almost seen as the pure safe haven here. A, you're getting some yield for your money, and B, it's the U.S. of its safety, regardless of what's going on or what the politics are, things of that nature. But that's a great point. 10 years ago, Australia was over 5%. There was big differentiation. And even if you take a look at some of the other carry trades out there, Brazil, EM, you're getting crushed on those because the currency side is more than taking the yield side of it.
Yeah. And that raises another point that I found interesting a week or two ago. So I've sort of heard this narrative lately about how, people look at these international, this is sort of like a not trading thing, that's a little bit more longer term, but people look at these international bonds, like, German bonds, Japanese bonds, and they see these super low yields and they think, what U.S. investor in their right mind would ever touch that stuff, when treasuries are 2-3%. And you have to account for the fact that, if you're a U.S. investor, and let's say you put money into like a Vanguard international bond fund, and a lot of these international bond funds are currency hedged. So basically, you're not getting euro exposure,
right,
but you're owning German bonds, but you're hedging it out. And so what's interesting is when you do that trade, when you sort of hedge out your exposure and you're sort of short euro against the USD, that implicitly has like a 2% carry, tailwind in it. And when you add that, so if you just look at the nominal yield of a German government bond at 50 basis points or whatever, you look at that and say, why would anybody have to do that? When you currency hedge it and you sort of short the euro against the USD, you're picking up sort of a 2% carry spread. And so it's not as if international bonds are, this is sort of I need to qualify the statement, but it's not as if international bonds for U.S. investors right now, given the yield differentials, are as toxic as they seem for U.S. investors. And I don't know if that made any sense, but it was something I found interesting.
Yeah, absolutely. Give me one sec. Let's see if there was one other question. No, that's all I had right there. Yeah, thanks as always, Adam. A lot of great information. Always very fascinating to take a deep dive into the CoT report and some seasonality. Adam Collins from Movement Capital. Thanks for joining us, Adam.
I appreciate it. Talk to you all later.
All right, talk to you later.